Right, well, good evening, everybody. Welcome to the Audit Committee meeting, our November meeting. Nothing's changed, really. We're still online, no face-to-face meetings, which is a great shame. So, apologies. Do we have any apologies?
No, Chair.
Thank you very much. Minutes of the previous meeting, which is to confirm the meeting held on the 23rd of September. Does anybody have anything to add to that, or can they be signed as a correct record of that meeting? Rachel, yes.
Hi, yeah, I was just wondering what happened to the survey that's mentioned on the Audit Committee effectiveness. I don't know if that's coming up in another part of the agenda, but it was supposed to be presented tonight, and I don't think it's gone out.
I think there is a delay on this. The SIPFA guidance that we were working to, I think, has been delayed slightly. I've got a feeling with the agenda the way it is, I think perhaps even the next meeting, our February meeting, might be a bit tight to deal with it. I'll have a word. I don't know whether, Madeline, have you got any news on this at all?
I was just going to say, well, apologies that members haven't yet had the survey. I am working on putting it together, certainly in the next couple of weeks or so. I hope to get something round to the committee. But as the chairman just says, we just need to look at sort of scheduling, because the next meeting may well be very heavy with items. But as I say, apologies that it's not with you tonight, but it's not been forgotten.
Thank you, Andrew.
Thank you. Are there any other points that anybody wishes to raise? Otherwise, we will assume that these are a true record and can be signed as such. Thank you very much. Thank you. Declarations of interest. Does anybody have any interest they need to declare? No, I can't see any hands. I'm going to have to keep going up and down because I'm not showing the full thing. Okay, doesn't look as though we have any declarations of interest. We come on to item 28, public question time. We have 30 minutes allowed for public question time. Do we have any questions from the public?
No.
None at all. Okay, we move on. And then member question time again.
No
do we have any? None at all?
No questions, Chair.
No questions. Thank you very much. Okay, we come to item 30, update on statement of accounts. This is a verbal report. Who's actually presenting this one? I don't...
it will be me,
Bob.
Chair.
It's Bob. Okay. Good evening, Bob.
Good evening,
Thank you very
everybody.
much. Couldn't see you there.
That's all right.
Right.
I'm only small.
Would you like to present?
Yes. The key observers will have noticed that we haven't got the statement of accounts coming for signature today, as originally was envisaged. The reason being is, once again, we are experiencing delays with the audit of the Berkshire Pension Fund, which is administered by the Royal Borough of Windsor and Maidenhead. And because of that, they are delaying to get their audit opinion on the pension fund, which doesn't allow Ernst & Young to provide us with an audit opinion on our thing, because obviously they can't provide an opinion on our accounts whilst there's still an item outstanding on the pension fund. So rather than try and do what we did last year and keep saying, oh, we'll have a special, we're intending to push it back to the February meeting, where we'll hopefully have an audited pension fund report, an audited set of accounts by ourselves, and also an audit report from Ernst & Young. I think Helen will probably say something in a minute on that. Just to point out that the annual governance statement as well, that normally would come, was due to come to this committee, is also part of the annual statement of accounts, and that will be eventually signed off prior to that meeting as well.
Thank you very much. Ria, you have a question?
Yes, just a quick question. In the last meeting, I think it was mentioned by Justine or maybe Bob, that there would have to be some extra work done to see about the value of property investments given the uncertain market. And I just wondered whether that extra work had been done after the 31st of March.
Yes, we've done a review of our valuations to take the impact of the COVID-19. Obviously, anything after the 31st of March is post-balance sheet event anyway. But we obviously need to make sure that it's worth noting there's been any changes to the valuations. I believe we had the revaluation report came in only a couple of weeks ago, and I haven't seen it as such yet. But I know my team will work on it with Helen's team.
Okay. I think I might have another question. It might be worthwhile mentioning now or later on. Actually, it's later on because we're talking about March 2020 now. Okay, fine. Thank you.
Thank you very much. Angus, you have a question.
Thank you, Chairman. It's a question to Bob. We've got this delay again from the Royal Borough on the pension fund. Is this going to be an annual thing? Because it does seem to me it's unacceptable that they continually are so slow in getting this out.
I would hope I could give you an answer on that, Angus, but I'm afraid I don't know. I would hope it's not going to be an annual thing, or at least annually they'll start delivering on time. I think Helen feels the same frustration as I do around it, and I know Graham has actually taken it back to the Berkshire treasurers along with the four other treasurers at Royal Borough, and even a Delhi treasurer Royal Borough has had something about it. Again, I believe it is Deloitte are digging more into it. Last year we thought it was a one-off because it's their first time running through the pension fund audit. It seems that they're finding more things or digging in there. I don't think there's any real governance issues around the pension fund, but I think they're just trying to get reassurance for themselves.
May I add something, Chairman?
Thank you. I'm relieved.
Yes.
I'm just going to say I'm relieved to hear that some action is being taken.
Okay. If I could maybe add, Councillor Ross, I think the message that we had from Deloitte, who are the auditors of the pension fund, is that they had hoped to provide us with the information by early October, and that was dependent on them receiving information, I think, both from the pension fund, but within the email I got, it mentioned third parties. Now, I don't know who the third parties are, but I think there were some delays in them receiving information that they needed to be able to complete their audit. So I think it's probably a combination of factors that have led to the delays. I think I would also, speaking as an auditor, also want to be fair in that this year has been probably the most challenging year as an auditor that I have ever had. In the same way that I'm pretty certain Bob would feel that it's been a pretty challenging year, probably one of the most challenging years that he will have had as Deputy 151 and in charge of finances. So I think it is frustrating, and I do understand members' concerns around that. I think Deloitte have been more helpful this year in being more clear about when they are trying to get their work completed, which allows Bob and myself to work together in terms of planning our work and how we report back to you, rather than, as Bob says, a special committee here, oh no, it slipped again, no, a special committee there. So as I said, I understand the frustration. I think it has been a complex and difficult year in terms of the impact of COVID on getting information, turning information around, coming through, and just actually from a resourcing perspective, I think all audit firms have faced those additional challenges. So whilst we've all resourced up more, that was not really with the anticipation of a pandemic coming that would impact in the way that it has done, and that has then changed the risk profiles, and that has presented its own challenges, which partly picked up in the Redmond review in terms of what needs to be done to try and fix the public sector audit market.
Thank you.
Thank you. Okay, are there any other questions? I can't see any, so I think thank you very much, Bob, for that. If you've got nothing else to add at the moment, I will move on to item 31, Wokingham Borough Council Audit Committee Audit Progress Report.
So, Chairman, I'll pick that. Yeah, I'll pick that up, Chairman. Thank you. So it's really following on from the previous item as much as anything. We thought it would be helpful to provide you with a brief update and reminder of the areas of audit focus. And as you've already heard, we've had the the information from Deloitte that they are experiencing their delays, which has sort of impacted on the completion of the audit. As I said, they've had their own staffing challenges, and so they're resourcing. They are going to go back to start their audit on the pension fund or continue their audit in early December. As I said, they haven't provided us with a firm date, but they are, at the moment it will be in advance of the audit committee that they are intending to report to in mid-February. So I suspect there will be a conversation that we will need to have about the timing of your February committee, which is at the beginning of the month rather than a bit later. So, but that's something that Bob and I will discuss. In terms of the actual report, I'm not going to walk you through it. It's not a particularly long report, and it's really just to give you a bit of a status update to provide the committee with some assurance that we have been doing some work on the audit, and that we have plans to how to complete that. As I said, this year has been more challenging, and I would say the two areas where COVID-19 and the effects of the pandemic have particularly impacted on the audit process have been around the valuations that were mentioned by Councillor G earlier. So that's where the valuers for the council will have included within their valuation reports a material uncertainty that's linked to COVID-19. That particularly impacts those properties that are either valued at fair value, like the investment properties, or at a market value, which might be at existing use value for some of the other properties. The firm has taken the approach that where we have assets that are valued at market value or at fair value and that are material, we need to use our valuation specialists. That team has been particularly under pressure this year because that has, given the extent of investment into investment properties by local governments, that significantly increased the workload from a public sector point of view. Equally, our corporate colleagues have a number of assets that are valued in that way and also have to call on that team's time. The second area of increased focus has been around going concern and the disclosures around that. So that is not to say that there is a risk around the council being a going concern, but it is more around, because of changes to the auditing standard that are coming in, more so for the following year, 2021, but we're in a bridging period, I suppose, is to make sure that your disclosures around that clearly state the basis of preparation. And then the final challenge, I think, that for everybody has just been the juggling of working remotely, working in different ways. And that's both for our team, and I think your finance team have obviously had the the juggling of continuing to deal with the audit, dealing with budget setting, and also dealing with the requirements that they've been asked to do in terms of managing expenditure, funding streams coming through for COVID. So I think there's a number of different challenges within that. So just to give you a bit of an update in terms of where we are, we've carried out sort of two split visits to date. So we carried out some work during August and we came back again at sort of back end of September and early October. We are now planning to come back in the week beginning 30th of November. So that's next week, probably not on the Monday, but certainly later in the week. My team had a meeting with Bob's team about 10 days ago to discuss progress, particularly on the outstanding queries that we left the team with when we left in October. And I think officers are confident that they're going to have responses to those matters that are on the query log. And we have a further meeting planned for this Friday, again, to sort of just check on progress, make sure we know we're all kind of on the same page as to when we're going to come back in and start auditing again, and also so that we can understand what pressures and what priorities the finance team have in addition to the audit. So that's kind of a bit of a sort of fleshing out the rather brief paper that we gave, but I hope, Chairman, that's been helpful, and I can see a couple of hands up, so I'm sure there are some questions.
Thank you very much for that. Yes, Rachel, you have a question.
Yeah, thank you. Just a couple of questions. Thanks for your report. The first one is on the valuation uncertainty that you just referred to, that's included in the external valuation. So that's page 17. Just to understand the process a little more, I mean, presumably your experts sort of speak to the external valuers, do they, and understand whether that level of uncertainty is actually material to us? Because I'm assuming this is quite a sort of standard clause that's included in lots of valuations at the moment. It may be actually their uncertainty is not material for us. Is that the way it sort of works in terms of process, or is it sort of more serious than that?
It's slightly more nuanced than that, I would say, probably, Rachel, in that you're quite right. The material uncertainty clause that's been put in has been a bit of a cover, I would say, probably, in terms of the valuers wanting to be clear that whatever value they will have placed on their, in their valuation reports as at the date that they did them may be impacted by COVID-19 from that. As I said, it doesn't apply to all, although it's a general caveat that's been included, it is really most applicable to those properties that are valued either at fair value or at a market value. So in terms of our focus, we have, as we would always do, select a sample of assets to be able to carry out more detailed work. In general, that would normally be carried out by the audit team, and we would only bring our valuation specialists in on particularly complex audits. Because of the uncertainty, what we've actually been required to do is to use our specialists where there is particularly where there's investment property, if I just focus on that for a moment. And the approach is that we would ask for the inputs that your valuer used to carry out their valuation that is now, that forms the basis of the entries in the financial statements. We provide that to our valuer, and they will carry out their own assessment. Now, our valuers won't come up with a specific number, or it's very unlikely they will come up with a specific number. They are more likely to give us a range to say that if the value, that there's the potential range for that asset, and if the value that your valuer has used falls within that same range based on the same data, then that's effectively kind of job done. So if there are some really knotty issues, or if your valuers have used a particular set of local knowledge, then yes, there would be a direct dialogue between the two valuers, facilitated by ourselves and usually involving someone from the council as well. I hope does that help?
Yeah, no, that's helpful. Yeah, thank you. The second point was ongoing concern, which you also raised. I mean, we'd said earlier that the main reason we don't have the accounts yet is the delay on the pension fund audit, but the report says that management haven't done the going concern analysis yet. Now, I know we have to wait till February until that can be finalised, or whenever they're actually signed. But in the meantime, has there been some discussion about that? Has been any sort of analysis provided as to what the key areas of uncertainty might be for going concern?
So it's a little bit of a point in time, because the going concern assessment needs to cover the period for 12 months from the date of signing the opinions and signing off the financial statements. So effectively, for the council, that will be February 22. So we have held off asking management to provide us with their sort of more detailed assessment of going concern, because they'll only have to come back and do it again in the new year.
All right, thank you.
Thank you very much. Maria, you have your hand raised.
Yeah, I've just got two questions. The first one's a very small one. What does REFCUS mean?
Revenue expenditure. Oh gosh, I'm going to have to try and get my words out. Revenue expenditure funded from capital under statute. So it is where. Sorry, this would have been explained in more detail in our audit planning report, and we've sort of summarised for this report, I suspect. So, and I may need Bob to come in and help me out, but effectively this is expenditure that sits within the council's financial statements as capital expenditure, but it is actually funded from revenue because it may have come from a grant or another mechanism, but which is actually revenue.
Okay, so you've had a revenue grant, but you've capitalised the expenditure, or the way round, or is it revenue expenditure funded by capital? Oh, you've had a capital grant, but it's really revenue. No, I don't get it.
Bob, can you help me out?
Yes, I can.
Thank you.
There are certain circumstances, and it is very tightly governed, by the SITFA guidance, that under circumstances you can actually use capital monies to fund your revenue expenditure. One example used to have to apply for Secretary of State approvals to use capital to cover revenue costs. Under the current settlement terms we've had, we're allowed to cover some transformation costs that normally would be revenue, such as maybe redundancy payments following a transformation programme from capital, items such as that. There's also a certain number of items that potentially, when we're doing works for other parties that we would deem to be capital works, we put those through as well.
Okay, so have we had any this year? And what would they be?
So I think, Councillor G, it would be better to probably come back to this when we complete our work, because we will report on this. So yes, we will have included it within our plan because there is material expenditure included within the financial statements. But I will take a note of your query about that and make sure that when we produce our final report, we've got a clear explanation.
Okay, thank you very much. And just one other question. So going concern. So I've been in meetings with various people from the council, and they've always told me that a council can't go bust. So if a council can't go bust, why do we particularly worry about going concern? And in what cases would there be going concern problem if a council can't go bust?
So if you think of a council that may have a very significant exposure to commercial investment of any particular type. So an example I tend to use is if you think about, I was thinking of Luton Borough Council that has an airport and owns Luton Airport. Okay. I would suggest that at that particular, for Luton Borough Council, they are probably looking very carefully at whether or not they have got sufficient expenditure, sufficient revenue to be able to continue and to hold that, and sort of whether that may or may not be an issue for their going concern. You mentioned Spelthorne. There are other councils as well who have invested very heavily in potentially retail or leisure developments, which are the ones that are probably more challenged in terms of whether their values are holding up currently, given the level of lockdown and the challenge in the retail and leisure sector particularly. So, yeah, you will have been told, because there is a presumption of going concern in the public sector, that councils cannot go bust in the same way that a corporate entity can go bust. However, councils can certainly have going concern issues, either because of an particular exposure to challenging circumstances, or because they have just run out of reserves. So I'm sure that members will have heard about the public interest report and the Section 114 notice that have just been made public about Croydon.
Yeah.
So councils can definitely have financial challenges.
What's the consequence then if effectively the government bails you out, so as statutory services can continue? And I think that's what they mentioned. Croydon have said they're only going to deliver statutory services, haven't they? So what does it actually mean then if the government always bails councils out? What is the issue with going concern? I still don't understand quite what it means.
But I think the point is that fundamentally it's one of the, or going concern is one of the auditing standards. It would be completely inappropriate for an auditor to say, well, actually the government just says it's not a problem, so we're not going to do anything about it. Yeah. What we're looking for is that councils disclose properly the financial position that they are in, and how they have judged that they have sufficient cash and sufficient liquidity to be able to meet their obligations over the next 12 months.
Okay, right. I understand that one. Thank you. Maybe I'll discuss with Bob some other time as well. Thank you.
Thank you. Bob, you have your hand raised.
Yeah, I was just going to say that there is obviously a consequence to councils that issue Section 114 notices. If you look at the case of Northamptonshire County Council, it's now split into two unitary areas. So the government will the government will step in and potentially help out, but it won't be as a sort of just here's some extra money. It's normally to help services and councils deliver what they need to do. The Section 114 notice is the safety valve mechanism that the Section 151 officer is allowed to declare, but unfortunately he's only allowed to or she's only allowed to declare it once the council has hit a position of being unable to continue. So whereas you can warn about it, you can't actually declare it until you hit that trigger point. But happy to have a discussion, Maria, anytime you want.
Okay. Thank you. Thank you very much. Okay, are there any further questions? Right. If a section 114 is imposed, does that mean that government officials would step in to help run the council rather than just financial support?
Yes, they can impose. In the case of Northamptonshire, I think they imposed a financial watchdog almost, or a financial expert to come in and manage it for them. So they'll take a lot of the control away from the councillors and also from the officers of the council to run that situation. And I can't remember the name of the person, but I did meet the guy at Northamptonshire, and he did say that he came in, was basically running everything. But what they do, as you alluded to with Croydon, they revert to providing what is statutory only. And that's basically what the 114 notice will say. The council can no longer provide anything other than statutory safeguarding type services. So even some of the things like emptying the bins can be adjusted, provided we're still providing our required minimum service provision around that. And again, even around children's services and adults, you can rein back on what you do. So whilst you're still providing a safe and secure environment for people, that becomes your minimum requirement, as opposed to some of the nice to haves that we do around those things. Although, as Helen mentioned, it is based very much on what level of reserves the council sits under. A nearby council was very close to running out of reserves. As you can see from the accounts, hopefully I see from the accounts that Wokingham does have sufficient reserves at this stage. So I don't think we have a concern around the 114 notice or the going concern. But obviously, Helen won't take my word for that. She needs to see the evidence.
Oh, sorry, thank you very much. Are there any other questions? Any other hands raised? No. Okay. Well, thank you very much for that. We move on to item 32, Treasury Management Mid-Year Report. Is that yours, Andrew?
Chair, no, it's Bob who's taking this
back
item.
to Bob, is it? Okay,
Yes.
well done, Bob.
The Bob and Helen show right now. Yes, good evening again. This is the mid-year Treasury Management Report. It is one of 3 reports that we bring every year to council. It has to go through to. So here, Audit Committee will recommend it, hopefully, or pass it on to Executive, who will then pass it on to council for council approval. It's required under the SIPFA Treasury Management Code that we must provide these 3 reports. The other 2 reports being the outturn report at the end of the year and the Treasury Management Strategy, which will be coming to this committee in February for its approval for the following financial year. Those that are eagle-eyed amongst yourselves will notice that the report is probably different from last year's. There is no requirement under statutory guidance that we have to keep producing the same report and just changing things. And part of my ambition since I've been here is to try and make what I hope is a more readable report for both Audit Committee and the general public. And in this case, this report here, we've done that. We still tick the boxes that it requires us to report the statutory prudential indicators that have not been breached. And again, we put an indication of where we think we're going to be at the end of the year in the mid-year report. But the main detail around comparisons, statistics, and what we've done will be in the outturn report anyway, which is normally a far larger report. But again, trying to make it easier. Also in this report, the Chief Financial Officer, Mr. Ebers, has asked me to make sure that we use this report to address some of the stories that have been put around the borough, suggesting the council is not on a secure financial footing. It is obviously a real concern of Graham as the Section 151 officer of the council that we have to demonstrate to the public out there that we are on a secure financial footing and we are managing our finances in a correct and proper way and in accordance with the various regulations that we put upon ourselves in terms of capital financing and treasury management. So that's the introduction to the report. If you're happy, I will take you through the report, Chair, to go through the key points of it.
Yes, please. Thank you.
Thank you. So, in summary, we're demonstrating in this report what the level of debt that the council holds in terms of its overall internal debt and external debt, and then the amount of that debt which is not funded by various investor save schemes or the income lines coming in through our development programmes. And that actually means that the cost that the council taxpayer has to fund is £7.52 for a average Band D property. I will have to point out potentially that figure is the cost of financing based on, if you come down to the first table, which shows us how much our budgeted debt financing costs are. So we're looking potentially at 7.8 million is the debt financing cost in the council's medium-term financial plan. When we deduct the various lines of contributions towards financing, and this is not the income streams, but this is just the amount of the income streams we deduct from the money coming into the council to cover off the cost of debt financing and repayment of the debt. The figure is a balance of £542,000. Take that, divide it by the tax base, gives us our £7.52 figure. As I say, those numbers in there in red in the report are basically what we deduct in finance from the income streams of the council to cover off the cost of debt financing linked to those various items. So you would have seen in various other reports talks of over £9 million being generated, which is the true income generation figure. But in this case, we've just taken out how much finance service deducts from the services to cover off the debt financing relating to those various streams of projects. The next one comes down to what we class as our net indebtedness, which takes us through the position where, as at the end of the year and the current year, we have seen an increase in terms of our actual financing requirement. There we've had a fairly static internal borrowing figure, which gives us an external debt figure that actually has increased during the year, but consequently set against that is our level of cash investment balances, and that's basically because the government has provided us with a fair amount of money and a lot of measures to assist our cash flow throughout the year, which was meant we've seen both an increase in the debt financing, but also, or debt taken on board, but also an increase in our investment balances. Now, the question that comes out from that normally is, well, why can't we just use the money we get in to pay for the money going out and not take debt on board? It would be if it's nicely matched, but unfortunately, most of the money that's in the cash investment balances is a short-term hold based on our cash flow expectations. So potentially anything up to 2 years we invest out for, whereas a lot of the debt financing will be for longer term. But again, going on from that, a lot of that internal investment balances will then replenish as we go through the year, taking in council tax receipts, business rate receipts, and again, any other government grants that come through. So taking the two away gives us what we class as a net indebtedness figure of £83 million. Then we come on to our asset values in the report. Again, looking at the table, we've taken the asset values off the balance sheet. We've then taken away assets that we class as non-realisable. We can't sell our roads to anybody. We can't sell our schools on, although if they academise, they actually get the value of the asset transferred straight across to them at nil value or nil cost to them. So we then take the hit on our balance sheet on those, but they're not realisable for money. So therefore, we start looking at some of our operational assets, items such as some of the council buildings we have, which we probably wouldn't ever realise unless there's a valid operational reason to realise that, i.e. they're surplus for our requirements, and that will be identified through the process, and the commercial assets, which potentially we can and are in some cases actively marketing to sell. So the town centre properties are being marketed for sale. The key mathematicians amongst you will notice that if you add the three figures up for the commercial assets, it comes to 193. That's purely the beauty of Excel and the fact that it rounds up and rounds down. But the figure is 192 point something. But when you take the three figures in there, it comes to 193. That's Excel there. Again, we've shown then there some of the standard asset ratios. I think the key point around the Treasury report, though, is that at no time during the financial year we have breached our operational boundaries for debt or our permitted debt levels. We have taken the advantage this year to try and convert a large number, well, not a large number, but a certain amount of our internal borrowing to external borrowing ratio to coming down to what is recognised as an industry standard rate, somewhere between 25 and 30%, which is what we've taken the chance to do. So we have taken on more debt, but that's because historically we've always been under borrowed as a council. And at this stage, I think that probably covers most of the report. And happy to take questions. I see there is a fair number of hands up, Chair.
Thank you very much for that. Daniel Sargent. Hello, Daniel.
Yeah, no, just struggling to get my microphone off mute. Yeah, thank you, Bill, thank you, Bob, for the report. I think actually just reading it back, I've answered my own question, because I was going to ask you whether the £7.52 was an annual number or whether that's some other time frame. But I think in the text it does mention annual. Is that right?
Yes, indeed, Daniel. That is the annual cost to the taxpayer. And as I said, that figure probably is slightly overstated because we don't take in the full income stream, just the amount of income stream that we deducted from our debt financing figure.
Thank you. Yeah, just to make a couple of other general comments while I've got the floor briefly, because I think the report's a very good one because, as you say, you've made a number of changes. It's a lot more clear this year, and I think you know, on the audit committee, we're not all financial professionals or anything like that, or even if we are, we're not specialised in public sector finance. So some of the more dense reports we receive sometimes can take a bit of unwinding to decipher what's really going on there. Whereas I think this report is an example of something that's very clear. You know, for some of our residents might be able to pick up and get some useful information from that. So I really like the direction you're taking the report in. Thank you.
Thank you very much, Daniel. Rachel.
Thank you, Chair. Yeah, thanks for the report, Bob. I have indeed noticed that the format of the report has been changed and it's not in its normal format. And coincidentally, at the same time, there's been lots of toing and froing politically between the Lib Dems and the Conservatives about the level of debt and the cost of debt. So I just wanted to point out before I ask my question that Audit Committee should not be used as a way of political point scoring. An Audit Committee, you know, is supposed to provide independent assurance. First section on the cost of financing debt. So obviously, sort of as you said, you've taken off lots of figures to sort of get to your net position, which is obviously a lot lower cost. Is this one of the changes that you've made from how you would normally present it? I'm looking at last year's report, and you've just sort of netted off returns on investments, and that figure, it's a lot lower than the figures here. So I can't tell if you've deducted more than you would normally in a presentation of this sort. And also, you know, would you agree it basically just depends which numbers you choose? You know, it's equally accurate to present this and say, well, the gross cost of borrowing is 7.8 million, which is like over £100 per household, not £7.52. You know, doesn't it just depend which figures you choose? But I think my main question was about whether the actual presentation of this net position has changed, or is that something that's consistent with previous years?
No, it has changed. As I say, potentially, it's not a political report. I quite fully respect the non-political aspect of Audit Committee. I've actually sat on and ran audit committees before in previous councils. I'm fully aware that it's not a political arena. What I did say earlier at the start of the briefing It is the CFO's request when he came to me and said, we need to make sure that the public understand the financial footing of the council. So it's not trying to disprove or prove or support either political party. It is a factual report stating this is where we are in terms of what it means to the local taxpayer. So it's a new part of the report coming through like this, partly because of the need to reassure people that we haven't got huge amounts of debts on there. And what it's just representing is that of the 7.8 million gross figure, not all of that is funded by the council tax, because some of it is funded, well, a majority of it is funded by various incomes from the treasury investments, from the commercial investments in the town centre and the housing companies there, and investor saves. So when we put in our gross figure for the budget requirement in the medium-term financial plan, it goes in at 7.8 million. But actually, the element that will be funded by the council tax, I say, is £7.52 per year for the local taxpayer. So that's just to point out that we're not funding that whole 7.8 million from taxpayer funds, but from actually income lines generated by the council through its commercial and also its normal activities.
Okay, thanks for that. Could I also ask about the net indebtedness? And again, in this one, spent some time trying to show the net position as opposed to the gross, which is, it's not necessarily invalid at all, but it's just a change to what we normally see, because I don't think, again, it was presented in this way last year. Just on a specific point on that, so taking off your cash investments, which, as I said, it's not invalid, but you do say later in the report that one reason that the cash balances are quite high at the moment is due to the COVID funding. Presumably that COVID funding is time limited or will be spent actually fairly soon. It's not sort of a long-term cash increase. So actually the net indebtedness will rise actually quite soon. It's just a sort of short-term increase that would disappear. Is that a correct analysis?
Yes, no, again, as I said, it is certainly not so much due to the actual extra money coming in, but the fact the government has given us certain leeways around when we pay some of our monies across back to central government. So they've given us freedom to not pay all our business rates money over straight away. So where we'd normally be paying it on a monthly basis, they've said, no, you don't have to pay it all. So we've got some more time around it. So yes, we can invest the money. It's our working cash that we can play with. I use the term play as a figure of speech. We don't play with it, but we use those surplus cash balances in the best sort of way we can to make sure we do generate some return for the council, but also to make sure it's not just sat in a current account, which is at risk, but into a secure investment environment. So most of the investments we've got have been out with other local authorities, some ranging from 3 months, others ranging up to 2 years. But it is shorter term as opposed to the long-term debt, because we can only borrow debt for long-term purposes such as capital investments. So there is a difference between the two. And as you say, that figure will come down, but it hasn't seemed to come down a great deal. In fact, it's grown throughout the last 6 months, and we're anticipating that some of it will come back in when we don't get council tax in months 11 and 12, because people are on the 10-month payment scheme. So we always find that February and March, we had to draw back some of our investments, and the investments are lent out for those periods of trough. So they come through then. So yes, you're right, it will come down, and you'll get more detail when we come through to the end of the financial year in the outturn report. It is again a request from Graham to me to make sure that we demonstrate what the actual true level of debt the council is probably sitting on. So the total external debt is that 449 figure there. But if you were to suddenly say, in the case of we go into liquidation, and we won't because of the going concern, but if you would say in normal private sector parlance, what's our cover between what we owe and what we have lent out, and that's a net indebtedness figure we're using.
Okay, thank you. Chair, could I just ask one other quick one before we move on to someone else? So this is on the asset ratios, page 24. How comfortable are you with the ratio of 1.5 to 1 for the realisable assets to external borrowing? And what would be the lowest that you would be comfortable, if you are comfortable, what would be the lowest that you would sort of allow that to go?
Yes, I'm comfortable with the 1.53. It's only, as I say, the case that if we were demonstrating in a private sector organisation what our asset cover is towards towards our borrowing lines there, the council has no potential requirement to pay back its borrowing other than when it generally intends to pay it back. So when we take a loan out, we'll take it out and we pay it back at the end. So there's never any creditors calling on us to say, oh, we want the money to pay in, please liquidate some of your assets. So it's more as a demonstration of a ratio to put some of the normal accounting ratios into the report. But in terms of reality, it's never likely to be a case where we would have to pay back anything earlier than we originally envisaged on the treasury management strategy we're working on and the loans we have. And we have a range of loans that go from potentially pay back within 2 or 3 years to some that go out till I think 2075 is one of the longer ones. That's been around for a good few years already. And hopefully once the PWB decide what they're going to do with their interest rates, I will look at trying to refinance some of those as well to try and get a better deal for the council.
Okay, thank you, Bob. And can I just say my point about political point scoring was in no way directed at yourself, of course.
No, I'm just saying that I was asked by the CFO that in this report we were trying to show the council is on a sound financial footing.
Where are we? Imogen, you have your hand raised. Hello, Imogen. Are you muted?
I am muted. I turned my hand off, but I didn't turn my microphone off. My question is that if, because you haven't included the loans in the housing revenue account, if you are a council tenant in a Band D property, how much would you be paying then?
It would be the same. There's no distinction whether on your council tax whether you're a housing tenant or a resident who is in their own property or rented property privately. The council tax is assessed the same way. So that tax base figure is 70. Get the correct right number of 72,000. Is based on everybody, including household tenants. The HRA is funded and self-funding through its income streams that come into it, not from the council tax.
I'm talking about if you're a social housing tenant. Obviously, your rent is going to pay going into the housing revenue account, or some of your rent. Or your money? How much of your money is being used to pay off this loan? Off these loans?
The loans around the HRA are ring fenced, so it would be purely not paying off any of these loans. The figure that would be is your equivalent of the £7.52, depending on what band you're in. So these loans are purely funded through that line there. The HRA loans are in a ring-fenced account. I can give you the details around it, but we deliberately excluded it from these figures because it is a ring fence, both in terms of the money that we go to pay those loans back coming from the rents and also for the amount in there of indebtedness because it's covered across from the housing rents. To subsidise the HRA from the normal council borrowing would require a decision to go through the budget process to say that we are going to put some money in from the council to subsidise the HRA costs.
But clearly, obviously, if you're a social housing tenant of ours, you're paying your money in and it's being used by the HRA account. So there is a debt that's being paid off in that account, yes?
That's part of how the rent's set, yes. The rent will cover, obviously, the cost of maintenance of those properties and also the cost of the debt around them. But I know a lot of it was almost self-funded, but I can get the details around the HRA if the committee so want me to bring to a future committee, because it is purely internally it's ring-fenced away from the normal debt of the council.
Absolutely, okay. With the internal borrowing, which is not on this list, obviously the reports have changed. With the internal borrowing on this list, there is obviously interest charged on that internal borrowing. And, you know, obviously that's a debt that has to be paid off as well. I'm sort of wondering, you know, how does that reflect in this report?
There is more, not so much interest on internal borrowing, but an opportunity cost of what we would be doing with that money if we didn't use it to offset some of our external borrowing costs. Now, obviously, the opportunity cost around our internal borrowing at this point in time is frighteningly low because we don't have a very good return on investment in terms of putting things out on the money markets. As you know, the bank rate is still at a historic low of 0.1% or 10 basis points. We don't get a lot more of that. So in some of the treasury investments that I have done, we've stopped doing them because the cost of the chap's payment to put the money out with somebody is actually exceeds the amount of interest I achieve for the period of time it's out for. So yes, there is an opportunity cost to it. It's negligible at this point in time, and it makes sense where we can to use internal borrowing rather than going out and borrowing at potentially 2.5% from the Public Works Loans Board. So that's why we do use the internal borrowing. It's basically using some of our longer term reserves to make sure that we're getting the money to go there. But again, it's all based on when the money comes back in and what we do, which is why when we got told by our advisors that we're historically under borrowed, we did actually take on more borrowing and debt just to try and balance that equation up.
But there is interest paid on internal borrowing, yes?
We will make a charge to the services, and what we're doing right now in my team is a piece of work to work out our internal charging rate for what we charge the companies. Currently, we have, if you talk to some of the services, put in a notional rate that may be higher than the service thinks it should be. So in order to prove that, we're doing a mix based on our internal borrowing and obviously the rates we're getting on our external borrowing. The issue, of course, is it's not exact. It can be an exact science, but it's very difficult because obviously terms of borrowing vary things. So whereas I may go out and borrow, for example, £10 million at 2% because it's a good offer at the time for 10 years, that will cover some debt that potentially might be longer than that. So I'd have to re-borrow for another period of time at the end of that debt maturity. But it's just picking up when the best times are. What we don't do is we don't borrow for 40 years for an asset that's only going to last us 5. So we do make sure that though we don't link directly to assets because we're not supposed to under the Prudential Code, we do have a mix where we look at what potentially the money's being used for. So that would be that we don't borrow, as I say, 40-year money for an asset that's going to waste out in 5 years' time.
Okay, thank you.
Thank you very much. Maria, you have a question?
Yeah, I've got quite a few, if you'll forgive me, Bob, on these. I sent a couple to you and you've answered some of the questions this evening already. If, as you say, you don't borrow for particular investments, why is it reasonable to show the financing costs offset against the general fund?
Yes, no. What we do, when I say we don't borrow for particular assets, we don't. So, if, for example, the property investment group decided to go and buy a Waitrose, as they have a habit of doing, Damon, who's the head of investments, came to me and said, "Bob, I need £9 million to go and buy this Waitrose." I won't go out that day and borrow £9 million. It depends purely on what we have in terms of cash balances, where we are in terms of what we think we're going to need the money. So at some point in time, I may go and borrow that £9 million, but it's not done the same day. So it's not directly linked, as in this is I'm buying a car, I therefore need to get a loan for it. It's a case of we are getting a car at some point, and I will then borrow the money when I need to borrow the money. Notionally, if I've got a surplus of cash sat around, I would use that before going and borrowing, so I could then potentially get a better opportunity to borrow in the markets.
Okay, thank you very much for that. I'm just wondering how reasonable it is to do a ratio which has realisable assets in it, which is the first time realisable assets have appeared, as far as I can see, in the Treasury Management Report. If they're things like buildings, you're never going to sell them. What's the purpose in calculating a ratio with them? Given what you said earlier about going concern, I don't understand the purpose of the ratio, really.
It is, again, just trying to demonstrate that the council has a form of asset cover for the level of indebtedness that it holds. So, as I say, we strip out what we class as non-realisable. So, as you're fully aware that everything becomes liquid in the long term.
Indeed.
So if we were in a case where we did need to liquidate the assets, we can certainly sell the assets from the property investment group. There's a red market out there. That's a fairly liquid asset. Operational assets, yes, they potentially are. But again, some councils have done what they class as a sale and lease back on them. So, you could sell the assets to their market and then lease it back. There's no argument whether that's a good use of revenue monies, but it does allow you to have those things. So in theory, we don't potentially intend to realise these assets at this stage, as far as I'm aware. I'm not privy to everything, but certainly no one's given indication to me that I need to start selling. But what we will do is we could, if needs be, and I suppose that's the real key to it all, if we ever needed to, by liquidation, we could realise those assets. Whereas certain things like the highway infrastructure, schools, they can't be.
No. Okay, thank you for that. In last year's report, the cost of debt financing was about the same as in this year. So 7.4 million was the budget and 7.3 million was the forecast. But the income that you offset, so the return on investments last year was only sort of 3.5 to 4 million. So I think Rachel sort of alluded to this earlier. What's changed so that this year you've got 7.2 million, whereas last year it was something like 3.6 to 4 million. What have you offset this year that didn't appear in the Treasury Management Report last year?
I haven't got last year's report up. If you see, I'm going to try and find something. So
it was called just last year. It was just called returns on investment, and it's on page 220 of the audit committee for February for this year, and it just got returns on investments 3.6 million and 4 million. So that means that the net cost of financing was predicted to be 3.3 million in February for the whole of the year, but yet this year we're down to 542,000, which seems a remarkable change. And I think that's why I'm not particularly comfortable with changing the format of the report without an explanation as to what's actually changed, so that we can compare one report with another.
I suppose we're not showing in the contributions line. That's not the return on investment we're getting in there. So this is just basically showing the level of contribution to that 7.8 debt financing figure. There must be something different in there. I will go back and check that to make sure. But again, it depends on what they were classing as investments at the time, because potentially some of the new investments like the town centre are coming online, whereas they probably weren't last year. So again, I can go back and compare the two figures and provide a reconciliation.
Yeah, if you can provide a reconciliation, that would be great. Okay, I'm looking at the net indebtedness cover of 5.98 to 1 now, which I did calculate for myself before, which was 496 divided by 324 minus 204, 496 over 83. So in terms of net indebtedness, and I think by deducting the 241 and getting 83, it's made the denominator significantly lower. Why not choose 496 plus 241 and divide that by 324 or divided by 449, however you want to do it. It seems to me a little, as Rachel said, the cash sort of fluctuates from sort of month to month, so it's sort of short term, and it mentions that in the report anyway. But taking the 496 and dividing by 83 rather than taking 496 plus 241 and dividing by 324 just changes it dramatically. And it just seems to me a little bit, it just sort of, there could be a lot of different choices of ratio, and I'm just wondering why you chose that one.
Well, again, it's just using the figures that we've previously produced in the report going through. And again, it is that, as I say, it's never going to be a case where we will actually probably have to realise to pay off our debts, but it's demonstrating that actually the council has sufficient cover from both its assets that it holds in the balance sheet, and also the level of debt that is probably the true level of debt, net indebtedness, when we take out all the other factors in there to bring us down to the 83 figure.
Yeah, I think possibly it might have been more reasonable to group the asset types together, so to group the realisable assets and cash investment values and then divide by the total external debt, or in fact you could do the general fund as well. For me it would seem equally valid.
Potentially, but again, when we look at the asset values, we're not carrying in there any of the asset values that are on the current assets. So the level of treasury investment that we have is equally more liquid than some of our long-term fixed assets, and so therefore the net indebtedness allows us to bring that figure in.
Okay. Right, thank you. Just, I think I've just got one last question. Yes, so with the numbers, which I wrote to you about, the email about the Community and Corporate Overview and Scrutiny Committee, there was 9.2 million. Does that mean that there was £2 million net left over to go to the vital services to be provided to residents? So I'm intrigued with the 9.2 million and the 7.2 million, as I wrote to you about. And there have been two different comparisons made about the investment income. And one is that it offsets the debt charges so that residents only pay a very little amount from their council tax to support it. And then the other argument is that the income streams provide vital services. And I don't see how those two are compatible. Arguments. It's either one or the other, unless there is £2 million left over to fund vital services, whereas the financing income, if you like, or the interest return services the debt. So is it £2 million left over to fund vital services and the rest of it offsets the council tax?
Yes.
Yes. Okay. Do you think you could provide me with, provide the committee with, to show how the 9.2 gets to 7.2 and then what's released?
Yes. What we have, and again, I've got these figures. We basically have 1.1 million additional income above the debt financing costs on the property investment group assets. So potentially we're talking 3.9 coming in rather than 2.8. All I've shown in this report is, in fact, the 2.8, which is the amount we take from the property investment income to fund the debt financing charge. But the actual income into the council is 3.9 million. So there's 1.1 million there. In the Working Town Centre, there is about another 700,000 over and above the amount that's taken out from that income stream for debt financing. And then there's potentially about 200k coming through as dividend income and money coming through the housing companies based on what we do. So that gives you 2 million. So yes, as you say, this provides a vital ability for the council to continue with services without having to increase council tax through a referendum or to actually cut services away, which is potentially why we are doing a lot of the work in the council to make sure that we can protect those services. And again, Can't say for other councils, but a lot of other councils are doing exactly the same thing to make sure they have the funding to support vital services to the public.
Yeah. Okay. I think it would be tricky to show the net income from investments, regeneration estates without ending in the argument that you can't actually borrow for some things outside the borough, or you don't actually borrow against those. But if you could show the investment, regeneration estates sort of gross, which is what you've got in corporate overview and scrutiny, and then the interest and how you've arrived at that, and then the next, that would be really great. Thank you.
Certainly, as I alluded to earlier, because part of it is because we have as Helen said much earlier on, the council's finance team is very, very stretched right now around setting the budgets, closing the accounts, signing those off, monitoring the budgets for the current year, and all the COVID-19 reporting to central government. And believe me, we probably report more things now than we've ever done, and I can ever remember doing in my time in local government. And it is really a case that we try to shorten the report. I will produce a full suite of documents around these, and my intention, sorry about that.
Oh dear.
It's not COVID, it's just a tickly throat, is when we produce the report next for the close down, we will show not just only the amount of money we're taking from the income streams to cover the debt financing, but also the amount of money total those income streams are making. So again, it's not really treasury, but it does provide that bit of reassurance around it that we are not just covering our costs, we are more than covering our costs, which justifies why we're doing things.
Okay, thank you very much, Bob. I know you're under a lot of stress and everything at the moment, and I appreciate you doing that. Thank you.
Rachel, yes, you have a question.
Thank you. Just one further question before we move on. It was just wanted to look ahead for a moment. Now, we know that borrowing is going to increase, and that if you include both the external and the internal borrowing from our reserves, it does go up to almost this 700 million figure in 22-23. Now, in previous graphs that we've seen, it's shown the level of debt falling off after 22-23, and we spoke last time about the effect of COVID on the timing of actually that debt reducing. Do you have an idea what the position is now in terms of, will it still go up to that 700 million figure, taking into account all the caveats you've already mentioned? And when do you expect that now to actually start reducing compared to the graph that we saw last time?
Yes, and again, that is total debt, so it includes internal levels and external debt going through. So again, we will remain within our operational boundary and authorised limits for debt as per potential indicators, which will increase each year with the treasury management strategy that we release. So we will hit a peak debt, and I believe due to COVID-19 pandemic, the graph has probably shifted slightly to the right. So the time of peak debt will be moved into later years, but also the time when we start repaying will be down there. So whereas the shape of the graph may not change, I think it will move slightly along and I always get this wrong, I believe is it the x-axis, the one along the bottom, but the time frame. So it has moved out probably 12 months or so. But again, it depends on the pace that we can really start to recover as a country from the COVID pandemic and where we go through. But the intention is that we'll always make sure that at any point in time, the debt, when it goes up, will be managed and within our prudential limits. It's worth pointing out that as the debt goes up, so does our asset base. So again, we'll probably look at the same sort of cover on there, and we're not increasing a great deal of what I would class as our infrastructure debt, which is around about the 100,000 limit. So the stuff that comes through from everything else in terms of the investor save properties, the town centre regeneration, we'll start paying back, and we're already starting to see some of the capital receipts coming in around the town centre area, and also the revenue returns coming through to pay back that debt. Because obviously in our debt repayment and debt financing, 7.8 million figure includes not just debt interest, but also the debt repayment we're putting through as well.
Okay, thank you.
Thank you very much. Are there any further questions before we move on? If not, thank you very much, Bob, for that. Thank you for the questions, and thank you, Bob, for the answers. I think we can move on. Just one thing I noticed earlier in this evening is that we've had a press release, I think, trying to explain to the residents exactly our financial position and where we are. And I think it's actually quite a good press release. So I think it would be worth reading. I don't know whether anybody's seen it, but I saw it just before I came to the meeting. So hopefully that will allay any fears that the public may have about our financial position.
We've seen it.
You have. Jolly good. Okay, we move on to item 33, the corporate risk management report. And sorry, yes, Angus.
We accept the recommendations in the agenda.
Oh, sorry, yes. Yeah, we have 5 recommendations. I think there's only one we need to actually vote on, and that's the first one. The others are all to note. So if we can look at the first one, which is the Audit Committee to support this report and recommend to the Executive, and the Executive will then be asked to recommend it to the Council. So if everybody is in favour, all those in favour of submitting this report and recommending it to the Executive, can they please show their hands now, please? I haven't got the full list here. I'm hoping somebody else can count them going down. I have 3 at the moment. 3, 4, 5, 6. Am I right, Madeline? Can you see? I've got 7, I think. 7, 4. Am I right? Can anybody agree? I will take it, if I'm hearing nothing else, that there are 7, 4.
I'm only seeing 4.
Only 4.
Who have you got voting for?
I'm only seeing 4.
Well, I've got... wait a minute. Yes, sorry, you're right. No, I'm looking at the screen and the participants. So I have myself, Daniel Sargent, Angus Ross, Diane King, and that is the 4. Yes, they are repeated, sorry, on the screen. Okay, so we have 4 for the report going to the Executive. Can those voting against, please, could lower your hands first? Thank you. If you could lower your hands. Diane, thank you. Right, those against, please show. 2. We have 2 against. Okay, and I will just ask for abstentions. Can you lower your hands, please, just to see that the numbers balance? Abstentions, we have 1 abstaining. So I think that totals up the right number. So thank you very much for that. That is carried and will go to the Executive to be presented to the Council. Thank you. The other items are to note. If you've got your agendas in front of you, you will know what we're saying. If you haven't, I can read them to you. But anybody who hasn't got them in front of them and needs to have them read, I will read them. But in the interests of not boring you all, I will take it that you have them. Maria. Yes, Maria. You're raising your hand.
Yes, sorry, I didn't turn my microphone on. I'm having another Boris moment.
Right.
Item 3.
Yes.
Because the calculations this year are so different from last year, I don't think that item 3 is justifiable. If the borrowing deducted last year was only 3.6 to 4 million, or so the cost of the borrowing is only 3.6 to 4 million, how can it possibly be 7.2 million this year? And I just think this is so incomparable with the previous years. We might note it, but I don't think we're noting anything that's in any way correct.
You think the figure that we're saying there of £7.52 per household on a Band D house is not correct?
I don't think it's justifiable. I mean, it's correct in terms of there are numbers that go into the calculation which appear on the page, but because the £542,000 cost this year doesn't compare in any way, shape or form to the 3.3 million last year, I don't see how that can be justified, because it's just so different. And one of the fundamental principles of accounting is that you need comparability from year to year, and therefore I think this breaches one of the fundamental principles of accounting, which is comparability and consistency. It's not consistent with last year, and that makes it incomparable to last year, and I don't see why it's changed. And Bob did say he'd come up with the figures for last year and work out why there's a difference this year. I think it's misleading.
Okay. Right. Does anybody else have Sorry?
I said I'm going to agree with what she said.
You're going to agree. Okay. So at the moment, we have two members who feel that this is not a true reflection, but we're only asked to note it, so it's not a vote. So I will wait to see whether Bob comes up with something, perhaps at the next meeting. Is that okay, Bob? Okay. But on the others, 2, 4 and 5, again, just to note the content. Okay, thank you very much. Right, we move on to the item 33, the corporate risk management. I don't know whether Andrew wants to take the lead on this one, or I think Carol is in the meeting now, is she? I think I saw. Is Carol with us?
And I don't believe she is there yet.
Oh, right, okay.
I wondered whether you wanted to take item 34 first.
Okay.
Back to 33.
Yeah, we'll take item 34, which is the 2021 Internal Audit and Investigations Quarter 2 Progress Report. Who's presenting that one? Are you, Andrew?
Yeah, if I could start. So, members, it's on page 53. It is only your last meeting when you had the annual report, so it's not long since we went sort of quite comprehensively through last year and also the start of this year. So there isn't a tremendous amount to add tonight, but there were a couple of audits that you've asked some specific questions around in the past as a committee, equalities and the audit, the public health audit. So there's some information in the report for you with regards to that. I did, though, just want to take the opportunity just to introduce to you tonight Catherine Hickman, who's the lead of the team, and also Julie Barker, who is the senior specialist within the audit team. Julie, in particular, was intimately involved in terms of audit work around the follow-up on equalities and the public health work. And I'm very happy to take questions, and I know Catherine would just like to say a few words as well, but I'd also appreciate any feedback from the committee in terms of the presentation of these reports. What we are trying to do, and I think I said that last time in terms of the annual report, is hopefully we're trying to make it clearer for the committee to engage with sort of the information, but again, very, very happy to take any feedback. But if I could just hand over briefly, Chair, to Catherine.
Yes, thank you. Welcome, Catherine.
Thank you, Chair. Thank you, Andrew, and good evening, members. Just to make a few points about the progress report. This is progress to the end of September, the first 6 months of the year. And as has been mentioned earlier this evening, it has been a challenging year to date. We had difficulties getting some of the audits underway due to COVID-19, and we had to refocus our work. And we've also had some of our resources redeployed out of the team, and we have some vacancies we need to fill as well. So back in September, you'll probably remember I brought an in-year review of the audit plan for the remaining 6 months of the financial year. And subject to filling the vacant roles, we should still be in a position to provide an annual audit opinion at year end. And then obviously in the longer term, we aim to get everything back on the straight and narrow. I'll also just mention that we'll be starting the 2021-22 audit and investigation plan shortly. An audit committee will have the opportunity to feed into that. So in terms of the audits and the position of them, if you refer to pages 63 and 64, you can see the audits that we've been undertaking to date. And you will also see there's quite a lot of audits scheduled for quarter 4, so it's going to be quite a busy period. And then just finally referring to the point that Andrew made, members, you'll be aware that when we do our audits, we give an overall audit opinion, and we haven't had any new ones falling into the category 3, which is the second lowest category of audit opinion in the work carried out in the first 6 months of the year. But we had 2 audits that we've been doing follow-up work from last year that were category 3. And we're pleased to report that with all the work that's been undertaken during the year, these have both now improved to category 2. And those were the public health and the equalities audits. My colleague Julie has been overseeing and tracking the improvements in those audits during the course of the period. So that's all I really wanted to report at this stage.
Are there any questions at this stage? Yes, we have. Maria.
Yeah, I don't have very much to say about the audits that have been carried out, but the report itself just confused me a little. So I wasn't really sure what. So if we take page 59, for example, so there's 4 H's, 13 M's and 0 L's, but I don't really know what that means. And the assurance, I think, possibly could say substantially, what's it called now? It's substantially complete and generally effective. I think that's what that means, isn't it?
That's correct, yes.
Yeah, but I don't understand what the H and M and L. Does that mean there's sort of 3 areas been looked at and they're, I don't know what that means actually.
No, that relates to high, medium and low risk concerns. So we categorise them as part of the audit. So the high risk ones, the more critical ones, and we'd look to follow those up within about a period of 6 months just to make sure everything that needs to be addressed is being, and that things aren't just sort of drifting along. So that's just our way of categorising the concerns that we make.
Okay, would you normally report which areas were high risk concerns?
In previous reports, sometimes we have given a synopsis, and when we reported on these 2 audits previously, we would have given some narrative to explain why there were high risk concerns. The purpose of this report is just to give a follow-up, just to say things are moving in the right direction and they are being addressed.
Okay, probably it would have helped. I know we should go back and find out what the previous things were, but there's normally quite a lot of papers. It would have helped me, I think, if I'd sort of known what they were and the follow-ups and everything. And then just going on to Appendix 1. So the column or the 3 columns headed RECS. I don't know what RECS is. And
that's recommendations or concerns, yes.
So they are, so for equalities, for example, it's 413 zeros. That ties up with what we had above. So they are concerns, or they are concerns which have been sorted out, as it were.
These were the concerns as they were, but they've been followed up and they've now come to the overall opinion of substantially complete and generally effective.
Okay, so the substantially complete and generally effective means that the 413.0 means that we can give that opinion, or does it mean that the 4 is now a 13? I'm just not quite following the logic of this report.
Sorry, Andrew.
Well, I was just going to add, I asked for feedback, Maria, so thank you for this, because I think this is a bit of a new format for us, and it's clear that we've got to put a bit more narrative in there. But I know Julie wants to speak, who did that follow-up work, but as Catherine's just said there, the original recommendations for the equalities audit are as set out: 4 high, 13 medium. What Julie did in that follow-up work is particularly focused on the 4 high ones to assess how they've been implemented, what sort of direction of travel we've got on each of those, and indeed some of those 13 medium recommendations as well. But we'll certainly take that feedback and make sure that the report is clearer.
Yeah, I'm not sure. I'm not sure I'm going to be able to recommend. Is it just to note? Oh, it's only to note. That's just fine. Just to note it. Yeah, I'm just having difficulty following it. I think in terms of what it means for how the past relates to the present. I think. Thank you.
Can I just go to Julie Barker, please?
Yes, hello. Yeah, I think Andrew's explained the approach that we've taken to the follow-up work. I could either send or I could either submit like a summary with a bit more detail on what we found in those 2 audits during the follow-up work, if that helps, or for future reporting, we could add a lot more detail or, a summary of our findings as appendices, if that would help.
Yes, that would.
Thank you.
Yeah, thank you. Thank you. Okay, Angus, do you have a question? Hello, Angus.
Yep, right, I'm unmuted now. Thank you, Chairman. Just a small point, perhaps, confusion. Page 60, we've got the public health audit update, and we've got the scoring of 360. And then if you move on to Appendix 1, it's not applicable. Not applicable, not applicable. Is this just a presentational thing, or am I missing something?
I'll have to hand over to Andrew for that one, because I think that was his narrative in there.
Apologies, Angus. I think it would have been more appropriate and consistent with the last discussion if we'd have actually put the same numbers of recommendations onto that appendix 1. I think, without sort of sounding like I'm contradicting myself, what that was indicating in the appendix is that there was follow-up work to that original audit. The original audit, as was already said, was some time ago now. But yeah, apologies for creating any confusion there with that one.
Fine, thank you.
Rachel, do you have a question?
Thank you, Chair. Yeah, in terms of the format, it would definitely be useful to see more about what those high-risk recommendations were and what action has been taken on them. And I know it's not our job to sort of go over every little detail, but we do need to get some assurance that proper action is being taken, and we do that by asking questions about some of the details. So at the moment, there's such little granularity in there, it's sort of hard to see what follow-up action and what improvements have been taken. So it would be good to add some more about the recommendations, what has been done, and also what has not been done yet. The only other point I had was towards the end of the report, it says there have been no restrictions on the work of internal audit in the first half of the year, but we have said already in the meeting that there have been some quite serious impacts on the plan. So I was just checking that is correct, and perhaps just relates to the overall opinion.
Yeah, what that phrase was intending to convey was that we hadn't had restrictions from management in the sense of not being able to get into particular areas for some more nefarious reason, if you like, as opposed to workloads, etc.
Okay, thank you.
Okay, are there any other questions? All very quiet at the moment. No. Noting only, I know Maria has expressed concerns over noting the contents, but other than that, I take it that we all note the contents of this report. And
Chair, I think you're on mute.
Sorry, that's it. I've just been talking to myself. It's very interesting. You missed a lot. Just to say that report is just for noting, and I noticed that Maria has an issue with that. But other than that, if you are happy to just note that report, that's all we need to do at this stage.
Actually, for this one, I'm okay. Actually, for this one, Bill, I'm okay with noting it. I was a bit worried we were going to recommend it, but with
okay.
I'm fine.
Okay, thank you very much. So that has been noted. Thank you. Okay, we move on. I don't know, again, we're still without Carol at the moment. Is there anything else on the corporate risk management that we need to deal with in Carol's absence?
Chairman, I see that Carol has joined us now.
Oh, she has?
Yeah.
Oh, hello, Carol. Welcome. Thrown from one meeting to another. So.
I know.
Okay, we're on to the corporate risk management, and if you're able to give a report on that, would be very much appreciated.
Okay, I don't have the I don't have the risk register, Andrew. Do you have that?
Yeah, could I shall I perhaps just introduce the report, and then I'll talk about or for Carol's benefit the headlines in the corporate risk register that are specific to children's services.
That would be great. Thank you.
So in terms of it seems like no time since this was last looked at, because obviously you look at this at every meeting. There are I would say no significant changes to the risk register since the last meeting, but I would draw the committee's attention to the bottom of page 28 and the top of page 29, which sets out some of the more minor changes in the report. There are no new risks, but we've made some amendments to some of the existing risks in there in terms of decisions and reporting and additional governance that's been put in place across a number of those. And I'm happy to take any sort of questions that members have got around the presentation of the risk register itself. In terms of, and I know you had quite a few questions at the last meeting that you were keen to talk to Carol about. So in terms of ones that are quite specific to children's services, there is delivering SEND reforms, number 5 on the corporate risk register. There is the safeguarding children and young people risk. And I know in particular there was questions about domestic abuse as well that was raised in the September meeting. There is the regulatory inspections risk at number 11, which, for example, is around Ofsted, but other regulators as well, and making sure that the council is prepared for those inspections. And the final one from children's services, or children's services specific, is the high needs block risk at number 14. So that's a sort of overview as to where we've got, but I think it's really just an opportunity for the directors when they come along to the audit committee just to share not necessarily just what's explicitly in the corporate risk register, but the risks that are particularly on the director's mind from their areas. And I'll pause there and hand over to Carol to take that conversation forward.
Thank you, Andrew. So yes, I mean I'm happy to take questions on the corporate risk register, and I did just flick through to make sure that I have got a copy, and I flagged it up, but I wanted to be on camera so that you could see me while I did a bit of introduction. So some areas of concern for me are the impact of COVID is not known. So we have, and I think children will be the last people to be impacted on, unless we have children that have mental health needs that we know about already. But in terms of family pressures and the impact on children's development, that will come further down the line when it becomes when those children have lived with that strain, in that strained environment, with those additional pressures for a period of time. So it's the unknown nature of what any future shape of children's services might need to be to address the impact of COVID that is not yet known to us. That's probably the biggest unknown factor and concern for a DCS at the moment. In terms of where we are with our delivery model, we are still making progress. We are still improving. We have, I think my staff have done a fantastic job during COVID in making sure that we've been delivering as many face-to-face visits as was safe to do so. So all 100% of our children on child protection plans were visited face-to-face throughout the period of the first lockdown. And obviously, then more children were visited, children in need, and looked after children face-to-face when we had the relaxation of the lockdown. And now that we're in the period we're in now, we are obviously risk assessing, again, cases where we feel that we should do a face-to-face visit, and all our staff are wearing PPE. They all wear masks now as mandatory, rather than we were advising that for those who felt more at risk or where they were going into risky situations, but now all our staff wear masks. We've continued to deliver services, albeit we've had to do some things remotely. So our child protection conferences have had to be held remotely. That's been a big challenge. Although feedback from our families has been that it's very daunting being in a child protection conference with a group of professionals, all kind of discussing you and your parenting and the safeguarding risks of your child. Parents have fed back to us that whilst that process is still really difficult, being able to be in their own home, in their own surroundings, whilst having those conversations, somewhat lessens their stress. So we are looking at lessons learned from the good things that come out of COVID and how we've managed to deliver our work in a different way. Some things, we absolutely need to get back to face-to-face. We need to get back to collaboration for staff in the office and all the sorts of things that, that support really, really complex work in children's social care. But then some of the things that have been really successful are that we've got many, many more partners around the table, virtual table. But because people are not having to travel and people are not having to factor that travel time into their meetings, we are getting much greater attendance at those multi-agency meetings than we had prior to COVID. So there are some positive things to come out of it. In the area of SEND, we are steadily making progress. We are making progress against our SEND improvement plan and our written statement of action. We have been slowed somewhat in some areas because it's inevitable that you have to recalibrate some of the things that you're doing under the circumstances of working in a different environment. But we've really developed our quality assurance systems. We've really stepped up our auditing program. It's remarkable, really, that we have continued to improve and not stood still. But we definitely are on a continuing upward trajectory, which is I have to take my hat off to all of my staff who've absolutely pulled out all the stops. In terms of inspection, I'll just cover this bit and then I will open it to questions. So Ofsted have changed their regulatory framework. It's now a sort of 12-month framework. So it begins at the beginning, if we take it as a sort of calendar year, although it doesn't always fall that neatly, but there's certain activities throughout the year. So in January, we have to complete a self-evaluation of our services, and that includes our SEND services and our children's social care services. It covers all aspects of every single team, every single service. We must review ourselves against where we were before, what actions we've taken, what we've learned, and where we are in progress. That is then part of a South East Sex-Led Improvement Triad Peer Challenge, which happens at the end of January, beginning of February, where they're tested and where we're grouped. Our partners are Surrey and East Sussex for our triad. Each council is paired, is sort of matched, with another two councils. So we will go through that. Our triad is on the 29th of January. We then have an Ofsted annual conversation, which happens anywhere between middle of February to the end of March, where Ofsted will review our self-evaluation. They will ask us where they think that we're making progress, where we think that things are difficult. They will not give us a judgment, but it's not a qualitative improvement or not improvement process. It is about us giving information and intelligence to Ofsted for them to plan their activity throughout the year. So then they may undertake a focus visit, which will not result in a judgment, but will result in a formal letter, which will be specifically about a specific area. So it will be a single 2-day process where they come and look at a specific area. In our case, they could look at our children with disabilities team, they could look at our fostering team, because they're the areas from our inspection that I think if I was an inspector, I would want closer scrutiny of. They may not, because of COVID, they may not do that. And then we could be subject to a joint targeted area inspection, because the last one that we had was in May 2017. The current theme for the joint targeted area inspection, which is a multi-agency inspection, but Children's Services are the lead body for that, is on contextual safeguarding. That is an area that Ofsted may want to visit us on in terms of progress that we've made in that space, and to check the partners and are working together. We've had a SEND inspection, so we're not likely to get another SEND inspection until 2022. And we've had an ILACS inspection, which is the independent local authority, the inspection for local authority children's services. Our ILACS inspection was in June 2019. So we're likely to get another inspection anytime early part of 2022 onwards. What we do know is will happen is that we will get a safeguarding during COVID visit. So we won't get a judgment, but we will get a formal letter on what we've done well and areas that they think that we may be able to improve or may have been able to improve upon. That is likely to happen probably early spring of next year. That's as much intelligence at the moment that I have in relation to the inspection activity. If that covers most of the things that Andrew referenced, I'm happy to take questions or to give you further information should you request it.
Thank you very much. I'm going to jump in first with my question. Just talking about child mental health, following on from COVID, there could be, I'm looking at a situation where a number of children, particularly those that are home tutored children, their only activities are perhaps, or their only opportunity to improve their social skills is outside of school activities. I don't know, scouts, cubs, dance schools, youth facilities, this sort of thing. Now, there's a number of incidences, I believe, where some of these outside activities are not going to continue after COVID. I know in particular, some of the scout groups are finding that their leaders are dropping off. Now, that's a concern for a child perhaps who is home tutored particularly, but it's a concern for all children, but certainly those at home tutored, that's the only contact they have with their peers. Is there anything, I mean, I know it's outside of your sort of remit, but is there anything that you can do to sort of ease this situation?
So we're working with the voluntary sector to ensure that where we can support extracurricular activity at the moment that can take place. Obviously, right at the moment it's not because we're in lockdown. But you know, post, well, whatever happens, and I didn't hear the Prime Minister's speech, so I don't know where we're at with the detail of that. But we'll get guidance. We do assess, although it's voluntary, for families to come forward to say that they will let us assess in terms of those that are electively home educated. And they do have to demonstrate that they're giving a well-rounded curriculum, which includes sort of social activities. But it does require the parents to be willing to engage with the local authority in relation to that. Our only other means of being able to have an oversight of those children electively home educated if we've got safeguarding concerns, because obviously safeguarding responsibilities trump everything else, if you like, and so we're able to then access and see the children. So it is a concern. It's a concern, though, that even when we do resume some level of normality, that children, because they are living through this experience where they're not able to socially interact with their peers in the same way that they did, that will have a long-term impact on their development. To make relationships, to be intimate, to understand, to develop empathy and all of the things that come with interacting closely with one's peers, particularly at certain points in a child's development. So it will be a particular cohort that will be impacted by that, for example. So yeah, it is a concern. I think that there will be lots and lots of research undertaken in this area, however, over the next couple of years, and there's already some beginning now. So it is just a matter of, seeing what the research tells us and then really adjusting the way in which we deliver services to meet the kind of the developing need. We won't know really what that is. As I say, I don't think probably we're not going to know the true impact for children probably for, well, I think at least another 12 months. So this is about future-proofing the way we deliver things rather than in the here and now. In the here and now, we're still responding to trying to ensure that we deliver services that need to be delivered. The future shape of what that means is yet to be determined.
Sorry, mute myself. Thank you. Rachel, you have a question.
Thank you, and thank you for your introduction, Carol. I just wanted to pick up something on the safeguarding risk, and it was that it's been noted there's an increase in domestic abuse as a result of COVID, and obviously it's good that that's been recognised, but I can't immediately see in the report, how this risk might be mitigated. Are you able to tell us a bit more about what has changed to try and deal with that as an additional COVID-related risk and try and mitigate it, taking into account everything you said about how challenging the situation is?
So the partnership has worked really closely in terms of increasing the visibility of the community's responsibility to help us to be on top of kind of dealing with domestic abuse. So only today, the Thames Valley Police have put something out for taxi drivers, etc., to say, you're our eyes and ears. Not just children, not just taxi drivers taking children to school, but but kind of just any taxi driver picking up any kind of person really. That giving them kind of information to feed back into the system. The police, for example, have a database of known victims of domestic abuse, and in this period of time, they did door knocking of those vulnerable families that had been previously known to them, and obviously it's a fine balance between not increasing risk in the household if the perpetrator's there and all of those sorts of things, but also reaching out to families to say we are here and we will prosecute and we do take this seriously. And given that that we're doing different things, it doesn't mean that we have taken our eye off this very important factor. In children's services, we have the Community Safety Partnership did sit in children's services until recently, but it's moved now corporately because it is a corporate response as opposed to just a children's services responsibility. But we have just recently advertised for a domestic abuse worker for children. So we will do that from children's services. It will be in line with the Community Safety Partnership priorities, but we feel that we need to have somebody with a specialist knowledge of the impact of domestic abuse on children. There's domestic abuse impact on the victim, but there's the impact of it on children. So that's one thing that we've done locally in children's services. The other thing that we've done is we have put an extra worker into BWA and paid for that from children's services as well, so that we know that the provider services, if you like, that we refer to have got enough provision to manage any increase in numbers of cases. Although having said that, we've stayed pretty steady with our reported cases. It's probably the more subtle pressures in family life that I think will impact on children's emotional development, and we're working with schools to support schools to work with that. So we've got mental health support teams in schools. That's another investment that we bid to the government, and we were successful in launching that service. So that goes live. Well, we've soft launched it already, but it goes live fully in the new year. And then we're also doing a lot of support to schools. So we've got we're just going to launch a therapy in schools service. So again, we're paying for it up front to train all the staff, and then we will do the kind of train the trainer approach. So it will become self-managed by schools in the longer term, but in the shorter term we're fronting it. And that's all really to address the impact of COVID, all of the associated risks with COVID, including obviously the impact of domestic abuse on children.
Okay, thank you.
Where are we? Imogen, you have your hand raised.
I do, thank you. Hello, Carol.
Hi.
More of a personal question, really, is that children who are sign language users, Makaton users, autistic children, who very much need a one-to-one teaching or a close teaching principle, how has that been managed during lockdown?
So we've just had to accept that in the environments where we have got children with those levels of need, that we are giving all the protective equipment to those staff, the personal protective equipment.
So they have been seeing them. Okay, yes.
We've not closed anything. We've just, in fact, we even paid for now I've got a summer break holiday club that Addington hosted for us, in terms of we were able to use their building, because we just know that that's such a vital service for those children, and is a really preventative service for them coming up higher into our statutory services. So absolutely. And we had long battles with the DfE about you can't really, how do you socially distance when you're working in such close proximity with children, these the children with these additional needs? You just can't. So we've just had to kind of forge our way through, really, and continue doing it. And all of we had a really, really high attendance of children with educational, health and social care plans throughout the whole period. And obviously now, all children are back. But for Addington, it's made no difference. They've had all the children in all of the time. So they've continued to deliver a really full-scale service.
Yeah, they're not all in Addington as well, all the sign language users.
No, not all in Addington, no. It's just an example. And Bridges, our respite unit for children with disabilities, we've kept that open as well throughout the period.
Right, okay. My other question is that there are obviously a number of children who have to are made to socially isolate because, say, COVID has got into the school, so their bubble has to isolate. So a lot of those children don't have home computer equipment and things like this. What are we doing to help those children?
So schools are much more set up this time around, because the guidance is now they have to have contingency planning, which means that they're providing the families with laptops, because they have to go straight to homeschooling. That's part of the. So the second, it's a bit like
not been happening, I'm afraid.
the learning from the first time round is that they've got to have emergency contingency plans straight away. If you know of cases where that's not happening, then if you could let me know, then I can pick it up with individual schools.
Right, okay.
That's the easiest way to deal with it, I think.
The other thing I've got is home to school transport for said children.
Yeah.
Were they still paid throughout lockdown?
Yes.
So even though they were furloughing their staff, we were still paying them?
Well, we were paying them through what's called a PSN agreement, so that we were just followed guidance in relation to what we needed to do. So yes, we were paying those because they were continuing to deliver services. So they weren't furloughed to a large degree, because they were delivering the services for us that they originally had. But again, there was clear guidance about that, and we just followed the guidance. There is some checking and balancing of that's going on now between finance, CTU, and the DfE, to make sure that we've got everything back if we've overpaid.
Okay, thank you very much.
Thank you. Okay, Maria.
Hello, Carol. I think I raised an issue at the last meeting about staff morale and about, you know, whether you've got enough permanent and or temporary staff to deliver SEND. I believe, although I haven't been on the council all that long, I believe that staffing did go quite low, and I just wanted your perspective on, you know, delivering SEND support at the moment.
So we're fully staffed, albeit with interim. So we got investment last year to increase the establishment in the SEND team. So recruiting high quality staff is really hard. It's because we are a small fish in a big pond, and you know there's lots of people vying for the same really good staff. So we do rely on locum staff. There's a difference between having permanence and stability. So permanence would mean, well, obviously we'd have to have all of our permanent staff. Stability, you can still provide stability even if you don't have permanent. So we have kept kept a stable group of SEND locums so that we could improve the services. We will, however, and are at the moment now gradually, going out to advert to try to recruit, but we won't just swap one lot of locums out for a lot of permanents because that will be disruptive. We will do it very sensitively so that there's a gradual kind of movement from locum, and they're not all locums, but the majority of the team are locum, from locums through back to permanent. But we've got a larger team, we've got a larger establishment now, so we've got more staff.
Okay, and is it possible or desirable to put the locums onto permanent contracts, or is that something that you can't do, or is it something that they don't want?
We do. We've had a number of social workers who've moved from locum contracts to permanent. It is something that we offer. It's quite attractive being a locum from a financial perspective, though, so not everybody can afford to do that. Mm-hmm. But yes, if they're good and they want to and they're committed, then yeah, absolutely, we would look to convert them if we could.
Okay, thank you very much.
Thank you.
Right, thank you very much. There's no further questions. I don't know, Carol, if you wanted to make any other observations or any comments. If not,
I don't think so.
No, you're okay. Thank you very much.
Thank you.
Thank you. Andrew, did you have anything further to come back on this?
No, it was really if there was any other questions, but the report is just to note, Chairman.
Yes, I noticed, Rachel, you've got your hand. Is that still up, or is it another question?
I've got questions on the rest of the report.
Oh,
okay.
You okay if I leave you then?
Yes, sorry. Yes. Yeah, the questions don't relate to children's services then, Rachel.
That's right. No, they don't.
Okay. Thank you very much, Carol. Thank you very much for coming along.
Thank you.
Thank you. Good night. Okay, Rachel.
Thanks. So I've got one question on the climate risk and then one on the financial risk. So on the climate risk, those are on page 47. In the further actions column, it says that officer responses to the task and finish group report have been agreed by the executive. But what it doesn't mention is that overall, that task and finish group concluded that the climate emergency action plan did not deliver the level of carbon savings needed and that more work was needed to demonstrate the plan was achievable. And it also said that the plan was likely to have captured only the low-hanging fruit. I also know this task and finish group was told there'd be a 6-monthly update in January 2021 to address the errors in the climate emergency action plan, which has since been refused by the executive. It also asked the council to commission an accounting style audit of the action plan's targets, its methods, etc. And again, this has been refused. So basically, the point I'm trying to make is that I would question the mitigating actions and say that actually they don't address the risk, partly due to the level of inaccuracy in the climate emergency action plan, but partly because there seem to be quite a lot of recommendations from the task and finish group that haven't been considered. Now, I know a task and finish group recommendations don't have to be accepted, but it just seems like there are a lot of recommendations and things being raised there that aren't being reflected in this risk register.
Well, I'd certainly note that comment, Chairman. I think in terms of the presentation of the risk register, that mitigation in terms of the task and finish group, yeah, obviously they looked at the action plan. They made recommendations to the executive, as you just said there, Councillor Burgess, and some were accepted, some weren't. It's clear that there's further mitigations to undertake. I mean, one of the areas that we probably need to look at is about an internal audit of the climate emergency project, which I think is something that we can bring back as part of next year's audit plan. But I'd certainly take those comments on board, and I'll feed those back to the corporate leadership team.
Okay, thank you. The other point was about the financial risk, the first risk, which is obviously rated very high. And again, it's about the mitigating actions. So I'm just interested to know, out of all of those controls that are listed there and all of the further actions, what are the sort of main levers that we have to reduce that risk? You know, say things did actually take a turn for the worse, and you know, forecasts are actually worse than we're expecting them to be. What are our main sort of levers of control to actually bring that risk down?
I don't know, Bob, whether you'd like to comment on that one in particular, in terms of any additional things that aren't there on the report already.
Yes, I mean, there's not a great deal that's not on the report, and I suppose it is very much a risk that, whereas we can treat what happens when the risk materialises, it's a risk we can't mitigate in entirety, because a lot of the factors around there are outside our control. So therefore, if we receive a reduction in our government funding, again, how do we deal with that? If we suddenly find our receipts from council tax and business rates have come down due to a financial recession, there's not going to do that. So I suppose what we don't want to do potentially is scare the horses by saying we would have to put in various measures to ensure we live within our budget. And that is the whole key area around that risk, is that whatever our budget we get is what we will have to live in. And obviously the last thing we want to do is to reduce in terms of the council, its services to the public. But again, that is where we come to. And I know such councils such as Doncaster, because of their financial position, actually did a review and said we will only provide what is statutory. Woking is not in that position as such yet. But again, it's more monitoring to find out where we are and to try and prevent us being in a situation where our level of funding reduces by, as you say, the mitigation strategies of lobbying to make sure we get the money in there, and also having a prudent and responsive level reserves. And again, part of the work that we do around our commercial activities without being prolific with our money and putting ourselves at high risk, because neither myself or Graham will allow the council to put itself at risk in that way, is what we do. It is really a case of just trying to take away some of our dependence upon the sources of income that actually could deteriorate.
Okay, thank you. I just had three quick requests, Chair, if that's okay, on the reports. One is on the Brexit risk. Could the risk register for Brexit be circulated? Because at the moment it's really hard to see what the risks are and how they're being mitigated. So would it be possible for us to see the risk register, the specific Brexit one?
Yeah, I'll take that action away and get that circulated to the committee.
Second one is on the equalities risk. I think last time I pointed out that it does say there aren't any COVID-19 related impacts, and we had a bit of a discussion about that. And I think it was agreed that the wording would be updated on that one, and I don't think it has been. I know that Overview and Scrutiny have reviewed it, and that, you know, the response was it would be included in there, but if the wording could be updated, that would be good. And then on the housing, it does say there'll be a verbal update. Is there a verbal update on that risk?
I'm afraid I haven't got anything this evening to add to the report. I was just thinking, Chairman, sort of which director you might want to get to your next meeting, possibly the director of place. Sorry, Chairman, you're on mute.
Yeah, that's fine. The next meeting, February the 3rd, is pretty full, isn't it? So, well, we hope it's full, because if we get the statement of accounts, it might be full. I don't know. Yes, I mean, if time allows, yes, let's do that.
Okay.
Thank you.
Thanks.
Okay. Right, if there's no other points to be raised on that item, I think that's again to note the reports accordingly, which I'm sure we've all done. And we move on to item 35. Oh, sorry, I've been muted again. Yeah, we move on to item 35, forward programme. The next meeting, as I said, is February the 3rd. So taking into account timescales and what we have available in time, are there any items that should be raised at this meeting that are not already sort of planned to be on the agenda? Anybody, any suggestions? Bob? Yes.
Thank you, Chair. No, I just wanted to make the point that the annual governance statement will also form part of the statement of accounts report. So that will be the signed annual governance statement there. So
Right.
it's just a bit of clarity.
Okay, thank you. Right. Helen, you have your hand raised.
I did. Thank you, Chairman. Just to help with the agenda management for February, if we are reporting the results of our audit to that committee through the audit results report, we may have an annual audit letter, so it might be worth keeping that on there, although we may not, but we certainly won't have the audit plan for 2020-21 because we'll need to complete the audit for 1920 first. So
Right.
It will be one item less if that's helpful.
Okay, thank you very much. Okay, well, based on that, are there any other suggestions for agenda items for the February meeting? I don't know, the date of the meeting after that, I haven't got. So where do we go after that? I don't know whether, Madeline.
That's the last date of the municipal year.
Yeah, it is. Yeah, so that would be the last date. So that's the last meeting. So take the opportunity to have anything included that you want to have included. Without that, we will go with normal agenda items. So based on that, I think the meeting has completed. So if there's nothing else to discuss, I thank you all very much for joining us and attending, and those that have presented topics, thank you for your assistance. So thank you and good night.
Thank you.
Thank you,
Thanks
Chair.
very much, everybody.
Thank you.
Good night.
Thank you, Chair.
Good night.
And thank you, the officers.